Today we're going to talk about inflation and measures of inflation. So here are different terms which are kind of related. So inflation is a persistent increase in price level over a period of time. Very simple. Hyperinflation, when the inflation rate is extremely high, like in 2 3 consecutive quarters we see extremely high number inflation rate, then we can say the economy is in hyperinflation mode. So disinflation, when the inflation rate is decreasing but it remains above the greater than zero, and deflation when it goes to negative. So CPI and PPI, consumer price index or producer price index, we generally use as a measure of inflation. So in CPI, we compare the current prices with the base year price, and the weights of a goods and services which we assign both to current and base year are likely to be significant different across the countries and region. Whereas in PPI, we also comparing the base price with the current price, but we track the price changes faced by the domestic producer. So we generally be talking about the same country and region. So there are two types of inflation. One is the cost push inflation. So due to decrease in aggregation supply, and causes the input factor prices to go up, like for land the rent go up, for capital interest go up, or for labor wages goes up, which actually uh, makes the prices go up for uh, so that's kind of a cost push inflation. So all the cost of factors of production is going higher. Because of that, we are facing the inflationary situation. Demand pull inflation, as the name itself suggests, it's caused by increase in demand. An increase in demand could happen when the government spending increases, when there is a greater money supply, when the interest rates are low in the economy, people are investing more. So in those situations, we can see the change in demand curve, aggregate demand curve can increase, which also can move the price higher. So that kind of inflation is demand pull inflation. Thank you.